Good evening from Delhi, ladies and gentlemen, and welcome to the second day of the India Policy Forum. We had a very eventful evening yesterday. Evening for us in Delhi, of course. For those on the Pacific West Coast, it's very early in the morning, and I'm particularly grateful that you have chosen to wake up and be with us this early in the morning. Welcome to all the panelists who we can accommodate on our screen, and beyond that we have a very large number of attendees as well, and we welcome you also to the second day of the 17th India Policy Forum. As I said yesterday, and I'll repeat that again, and then request my co-conspirators Karthik Muralidharan and Barry Bosworth to chip in. Earlier in the year, when we were thinking about the IPF 2020 and keeping in mind the pandemic and what was happening around the world, we still, of course, didn't have a good sense of what might happen. But anticipating that we would not be able to travel, we first thought that we might actually postpone and cancel the IPF, but soon realized that indeed it is precisely a forum like the IPF that's required in today's particularly disturbed setting, when we are in a position to debate and discuss policies, programs, and the outcomes that they yield in a setting like this. So that's the reason why we are here, and that's the reason why we can all see each other, but not quite in the same way as we are able to and feel and be with each other as we might have been had you come to NCAER. I'm delighted that all of you are here. The rules are simple. We have two very good papers today. First, on the overall economy, Prachi Mishra will lead off on that, and we have both a great set of commentators and, of course, Dr. Subbarao, former governor of RBI, will be chairing that session, and that will then immediately lead to a paper on health policy, Ajay Shah, and two fantastic commentators there as well, Dr. K.P. Krishnan and Dr. Randeep Guleria. They'll be introduced before the session, and there we have the Secretary-Designate Rajesh Bhushan, who will chair that session. So a very rich set of offerings today. Please feel free to take a break in between, turn off your camera, get a cup of coffee, take a toilet break, whatever you need to. Please feel free to come in and leave. We have no real complicated rules. There are 20 minutes for our 30 minutes for our authors, and then 10 minutes each for our discussants, and then we'll have the floor discussion. We have the full 90 minutes as we usually have in the IPF for open discussion. I would urge our panelists to please go to the participant button at the bottom of your screen. Press that. You will see a list of your names. Please, against your name, you will see an option to raise hand, and then that hand will show up on the screen, and the chair will be able to call on you in the order that they see you, and I will be helping the chair do that. For our attendees, you have a Q&A box at the bottom. Please feel free to write in your comments, address them to either the authors or the discussants, or in general, and we will seek to answer as many of them as we can in the session itself. There is a transcript of those questions that will be shared with the authors as well, and we'll encourage them to respond to you directly because we have your email and your contact address, so we will do so. So with that, let me welcome you all again. I see some great faces, and I hope that I can, and the chair will call on some of them, including his successors as well. I see Raghu, who has just joined us. So I hand over to you, Dr. Subbarao, and then after your introduction, we have a little timer there as well that will count down. It's a big help to our authors so that they can keep count of the timing. And in general, we've always been very good on timings at the NCR, and we intend trying to do that for this IPF as well. So again, welcome, and we hope that we'll have a very good evening and a very good afternoon and morning wherever you are today. So over to you, Dr. Subbarao.
Thank you. First of all, I want to thank IPF, Shankar Acharya in particular, for asking me to chair this session. It's an opportunity to which I attach a lot of value. This economic crisis triggered by COVID-19 is like no other. It's hurtling the global economy into a downturn, the deepest since the Great Depression. It's pushed China into a slowdown, the sharpest slowdown since 1992. It's barreling India into a growth contraction for the first time in 4 decades. We're seeing governments and central banks around the world ferociously fighting the crisis. Governments are embarking on aggressive fiscal stimuli. Central banks are cutting rates and taking quantitative easing into new territory. It seems like they're operating from the same playbook as in the global financial crisis of 2008. Although they're doing the same things, this crisis triggered by COVID-19 is quite different from the global financial crisis, and it's important to recognize that in order to zero in on diagnosis and remedy. As opening remarks, I want to point to 3 important differences. The first difference between the global financial crisis and this crisis comes from the origin and transmission. The global financial crisis originated in the financial sector. It is a consequence of excessive risk-taking. Pressure built up in the financial system and it exploded spectacularly. The solution was to restore financial stability. We saw governments and central banks in the forefront, on the front line, engaged in the task of restoring financial stability. This crisis, on the other hand, came from outside the financial system, from outside the economic system. It's a consequence of a new virus. The final, ultimate solution to this crisis has to come from science. Meanwhile, what governments and central banks are doing is just a holding operation. The second difference between the global financial crisis and this one is about the geographical spread. Even though the global financial crisis was called global, it did not affect all countries equally. Asia was less affected. China was even less affected. Arguably, it was the fiscal stimulus by China that prevented the Great Recession from turning into a Great Depression. This time round, there is no major economy that's not affected. This virus has not spared any major economy. There is no single country that can provide support to the rest of the world. The third difference between the global financial crisis and this one is about uncertainty. Every crisis is defined by uncertainty. There was uncertainty in the global financial crisis, for example, about how the markets might respond to unconventional monetary policies. But the uncertainty in this crisis is much deeper, as someone said, of a very unusual nature. How does the virus spread? How effective are lockdowns? What is the process of recovery? When will we have a cure? When will we have a vaccine? It's arguably, it's not arguably, admittedly a challenge for doctors and medical professionals, but equally a challenge for economists and policymakers to understand the nature, depth, and dimension of this crisis. It requires a sharp mind, robust research, and clear thinking. We have in Dr. Prachi Mishra, Chief Economist of Goldman Sachs India, someone who combines all these attributes. So it's my pleasure now to invite Prachi to present her paper on Whither India's economy post-COVID 2019. Prachi, go ahead, it's 30 minutes for you. Thank you.
Thank you very much, Dr. Subbarao. Hope I'm audible. Shankar, I'm audible, right?
Yes, you're very audible. Thank you.
Thank you, Shankar and the IPF for inviting me once again. And thank you, Dr. Subbarao, for chairing the session, and to the discussants, Dr. Acharya and Professor Joshi. It's really an honor to be a part of this illustrious panel. So let me give you an outline of what I plan to talk about in the next 30 minutes. I'll start with the global backdrop, then zoom a little bit into the spread of COVID-19 in India, and then go into, of course, the impact on the Indian economy, and more from point of view of the mechanisms rather than just the numbers. And finally, on policies as we are seeing it, in particular fiscal, monetary, and financial. And then I'll shift gears a little bit and talk about the challenges in the economic restart. And finally conclude with some policy implications. So clearly, I think we all know the world is going to be in recession this year. We are estimating a global real GDP actually fell by 16% in the 3 months from mid-January to mid-April. And we are now forecasting a contraction of close to 3.5% in 2020, with risks remaining to the downside. And this is almost certainly the deepest recession since at least the Second World War. I think the good news, at least from a couple of weeks ago, was that the global recovery has now begun and global GDP is rising. And the most striking piece of evidence that global recovery has begun was the US payroll data, which we got. And then, in the US, you actually saw active virus cases decline consistently since mid-April, despite, their gradual loosening of restrictions. And, in addition, the policy support, especially in advanced economies, has been massive, leading to stabilization and even increase in disposable incomes. I have to say that compared to a couple of weeks ago, the risks to global sequential recovery have gone up. And the main risk is what you see on the left-hand side chart. The virus has basically not been brought under control in the United States. And on the right-hand side chart, you can see that it's how it is looking like in particular for Asia and in India. And clearly, compared to the euro area, the situation in the US is strikingly different. And on the right-hand side chart, you can see that how the situation in India, where the virus situation is escalating very rapidly, is different from the rest of the region. In India, basically, we are adding close to 30,000 cases per day, which compares with less than 1,000 on average daily adds for the rest of the region. So clearly, I think the situation in the US, in India, and some other emerging economies, along with some of the localized outbreaks which we are seeing in different parts of the world, raises the risk of a further rise in infections as economies open up further. And that might trigger renewed government restrictions or voluntary changes in behavior that would be on growth. And some of it we are already seeing in India and in other parts of the world. So maybe next, zoom a little bit into the situation in India. The left-hand side chart shows the number of cases. The total number of cases now, this is in fact a bit dated, but the total number of cases now are close to 900,000, and India is second highest after the United States and Brazil. I have to say that the silver lining, at least what we thought a couple of weeks ago, was that the cases appear to be concentrated in certain states. So if you look at 8 states, they account for about 80% of the cases, and together 4 states. If you look at Maharashtra, which is here, Delhi, Tamil Nadu, and Gujarat, these 4 states were counting up to end June 65% of total cases in the country. As of last week, actually this pattern has started changing. And we are seeing the virus to spread beyond these top 4 states of Maharashtra, Delhi, Tamil Nadu, and Gujarat. In fact, if you look at the incremental cases in July, the share of these top 4 states is reduced to 56% of the incremental cases compared to 65% of the total case count until June. So very recently, I think over the last week or two, the bottom line is that the virus is spreading beyond these typical 4 states which we thought to be the leaders in the virus. This is, looking at active cases. So this is looking at total cases, subtracting from the total cases the recoveries as well as the deaths. So on the left panel, let's first look at the dark red line, and this is really the number of active cases for India as a whole. And as you can see, this has really been on a rise for the country as a whole. And even if this trend has continued, if you look at the data for last week, since, I mean, the way these things have evolved is, if you looked at, till end May, Maharashtra was not in discussion. Number of cases were accelerating in Maharashtra, and in particular in Mumbai. Actually, starting early June, as economy, nationwide lockdown ended and the economy started opening up, the attention actually shifted to Tamil Nadu, which is the gray line, and Delhi. And you saw a sharp spike in daily new active cases in these two states. And once, I think after mid-June, testing was ramped up, particularly in Delhi, and you saw the daily new active cases decline. I don't have, again, this chart up to last week, but if you look at last week, basically what is driving the trend is actually not any of these states. It's India minus the 4 key states of Maharashtra, Delhi, Tamil Nadu, and Gujarat, which is reporting a rising trend in active cases. On the right chart, you hear a lot that basically cases are accelerating because we are testing more. On the right-hand side, we actually look at, the positive ratio, which is number of cases, daily positive ratio, which is the number of cases adjusted for the number of tests. And except, a couple of things from the right-hand panel, except for, Rajasthan, UP, and Madhya Pradesh, where, it looks pretty flat. For rest of the states, actually, particularly if you look for Delhi or for Tamil Nadu, it accelerated quite sharply since early June as lockdown rules started getting relaxed. So it's definitely not what people said, that look, in these two states, it's all because of higher testing. Even if you adjust for testing, we saw a rise in number of cases. And also, testing was actually ramped up after mid-June. So, and then you do see, in particular, Delhi coming down, Tamil Nadu coming down, but Tamil Nadu actually rising again towards the end of June, after which the reimposition of lockdown in Chennai and 3 other hard-hit districts were imposed. Bottom line, I think, if I extend zoom this chart, which I don't have it here, if I zoom it to last week, India minus Maharashtra, the top Delhi, Maharashtra, Tamil Nadu, and Gujarat, it actually shows a rise in the positive ratio. That is, even adjusting for testing, you have a rise in daily new cases. Bottom line, I think virus is now spreading beyond the usual leading states. Let me move on to the economic impact. And let me say at the outset, this is a bit dated, as of mid-May. As of mid-May, we were forecasting the Indian economy to contract by about 5% in fiscal year 21. But then, GDP data for FY20 was actually revised upwards. So that mechanically led to a downward revision. So a contraction of 4.5% is what we are forecasting now, with risks to the downside. And I'll talk about the risks more, as I go along the presentation. But I think the main idea is to show you how I'm thinking rather than the exact numbers. And let me also say that, there's been a lot of narrative about uncertainties that, virus related, otherwise. I think one thing which we can say with a lot of certainty is FY21 is going to be a terrible year for India. And the left-hand side actually shows the year-on-year GDP growth by quarter, and the right-hand side shows the quarter-on-quarter annualized. So I think the right-hand side is the main chart, and you can see that there is we expect a very sharp contraction in the second quarter, which is April to June quarter, and data have been really poor in this quarter as well. So about a 45% quarter-on-quarter annualized rate of contraction in the second quarter, and then going to the third quarter, of course, there is going to be a pickup, but this is, people are getting excited about this pickup, but, this is almost mechanical. If you have a quarter with a very sharp contraction, the following quarter is, almost mechanically going to pick up. And so I think there is a sense, and I'll talk about it a little bit more, sense of complacency setting around this, which probably, we need to be cautious about that. Beyond that, for Q4, for end of this year and early next year, we expect a step down to a more normal and lower sequential growth pace. And the main reason for that is that, look, different parts of the economy are likely to recover from the virus at different speeds. So by end of Q3, you could possibly have manufacturing, where virus control is relatively easier, could possibly normalize. But in industries where, virus control is harder, travel or entertainment, for example, that will still be in a very gradual normalization process and probably won't rebound until a vaccine or other comprehensive medical solution is available. So the left chart is actually derived from the right chart, and there you can see the year-on-year numbers. And just to give you a sense that you actually need a pretty sharp recovery to get to a number of, to get to a figure of a contraction of close to 5% for the year as a whole. And let me also say that, given the reimposition of the lockdowns, which are actually not incorporated in the forecast, I think the risks to this number of 20% Q-on-Q annualized GDP gain are actually to the downside. So our quarterly estimates basically imply that, as I said, the economy would contract by 4.5% in FY21. And without going into any of the details which I bored you with in the last slide, I think if you assume, a reasonable assumption or rather conservative assumption is that, 50% of the activity is wiped out about 20% of the time. So the Indian economy was in lockdown for nationwide lockdown for 66 days, which is roughly 20% of the year. If 50% of activity is wiped out for 20% of the time, 10 percentage point of GDP is almost mechanically lost. And this is clearly, the deepest recession since 1980 for India. Again, I said, risks to the downside, and we'll talk about the risks more as we go along. So what are the mechanisms through which this virus is going to impact the economy? I think this is very standard macroeconomic mechanisms: consumption, investment, and export. So this chart actually shows where we were pre-virus and where the latest forecasts are, and it's more than a 10 percentage point downgrade in the GDP for FY21, and it works through basically three mechanisms. One is the decline in India's exports from a slowdown in global demand, as well as domestic supply chain bottlenecks, which are also important factor in determining India's exports. A hit to services, consumption and services, which is again, almost mechanical, arising from shutdowns, but also, virus fears, social distancing measures. And finally, a hit to investment from factory closures, dip in demand, and also supply chain disruptions. Let me move on and dig a little bit dig into the consumption spillovers. So this chart basically provides some illustrative estimates of how large the GDP impact of these consumption cutbacks could be for India. So the bottom of the chart basically shows what our assumptions are about the peak magnitude of these cutbacks. For example, you can assume that in peak lockdown, a 95% decline in spending on recreation and culture and in restaurants and hotels. And if you look at say sectors like housing and communication, they are limited hit sectors. And finally, if you have health and food as more offset sectors. So in total, if you add, so what these bars are basically showing is what the assumed hit in each of these sectors multiplied by the share of that sector in GDP. So in total, if you sum all these up, this would imply a peak hit of about 30% to monthly level of GDP through consumption spillovers. And if you assume, even if you assume that, that everything had become fully normalized by mid-May, which of course it did not, that would imply that the second quarter GDP would be roughly 15% below the norm, which is half of the 30% for the quarter. And if you assume a trend growth of 6%, which we are not assuming any change in potential growth, that would mean 15% below the norm for a quarter would imply the Q2 growth of -9% on a year-on-year basis. So this is with the assumption of an immediate and total recovery, which obviously did not happen. Therefore, the second quarter in year-on-year terms would contract by 9% or even more. Let me shift gears a little bit and talk about what has been happening sequentially. So the left chart shows PMI, and the right-hand chart shows exports and imports. And not surprisingly, when you have a PMI reading of 5, which actually people who monitored major economies and markets for decades have never seen a number as low as this. But when you have a number as low as this, I mean, it's almost mechanical. Where else can you go from here? So there is going to be a sequential improvement. And similarly for exports and imports, we've seen, and this has been true of other indicators as well. If you look at industrial production, a pickup in a sequential pickup, sharp sequential improvement in several indicators. And I have to say, I think our sense is that complacency seems to have set in among both market participants as well as policymakers looking at these figures. I think the point I want to put forward today is that, look, this is almost mechanical. Where can you go from the extremely low levels we saw in April? This is good news, but this has to be taken with appropriate grain of caution. Let me move, to policies from here. One question we often get is, why are we not forecasting a sharper pickup in the second half of the year? And why do we have like 15%, 6% Q-on-Q annualized rate of growth in the third quarter and the first quarter? And why don't we expect any more rapid sequential growth, which would mean that for the year as a whole would look better than 5% contraction? I think my view is that, look, macroeconomic policies have eased in India, and probably they're going to ease even further. But policy support, and in particular discretionary fiscal policy support, I mean, the kind of support, discretionary fiscal policy support is basically direct support to households and businesses. It's the kind of support which can minimize the second round effects of the pandemic and make any economy quickly recover in times of an unprecedented shock like what we have seen. Our calculations suggest that this has been very tepid so far. So on the left-hand side, you look at you can compare discretionary fiscal policy support in India compared to the world, to developing economies, emerging markets, US, but also China and LATAM, SEMEA, etc. I think, definitely, first of all, I think it's definitely much smaller than the 10% of GDP, which was announced by the Prime Minister. Our calculation suggests that it's about 1.8% of GDP. And in a cross-country perspective, it looks small, not only compared to advanced economies like the US, 12% of GDP, another 7% of GDP expected, but other emerging economies as well. If you look at the EM average, India looks very tiny relative to the emerging, other emerging economies as well. So in the right panel, I'm showing you what we call as fiscal impulse. So basically, fiscal impulse is typically people look at headline fiscal deficits and basically look at the change in the headline fiscal deficit and say that fiscal policy is contractionary or expansionary. What this does is actually looks carefully at each line item of the budget, central government as well as state government, and it basically assigns appropriate multipliers and lags to each item of the budget, and that's how you aggregate all this and get the fiscal impulse. So this, I think, the key to focus is the last bar, last set of two bars. And, FY21 budget, this is the budget, but this budget is not relevant at all. Budget framework is totally, irrelevant now. What is important is the fiscal impulse, assuming the 1.8% of GDP stimulus. So basically, we are estimating this fiscal impulse to be neutral, so close to zero, assuming that the government actually spends how much is in the budget. However, interestingly, what we are hearing is that government is actually instructed line ministries to not spend what is in the budget. So if you assume that the budget spending is not being realized, that would mean that the fiscal impulse actually becomes contractionary rather than neutral. So fiscal policy, rather than being a support to growth, is actually going to be a net drag on growth. A little bit on the medium term, I think clearly, fiscal uncertainty remains very high. I think FY21 for sure. I think if you have your nominal GDP in contractionary phase, revenues are going to fall really short of targets, and we expect fiscal deficit just for the central government at around 7% of GDP. I think budgeted is close to 3.5% of GDP. And if you include the states and if you include the public sector enterprises as well, that would imply sovereign fiscal deficit of close to 15% of GDP for FY21. But I think what is the implication of this for debt in FY21 and going forward? And here, I think, not surprisingly, if you have fiscal deficit rising sharply, government's debt to GDP ratio would increase from an estimated 72% in FY20 to close to 85%. And going forward, I think how the debt dynamics evolve would depend on the evolution of growth and the government's fiscal plan. So what I've assumed here is basically a gradual economic recovery and a sharp consolidation in the primary deficit. So basically, even then, for a couple of years, even with that, the interest growth differential is going to remain positive and going to put an upward pressure on debt to GDP. And beyond that, it starts declining as interest growth differential turns negative, and that puts a downward pressure on the debt dynamics, along with continued consolidation of primary deficit by the government. I think importantly, I think even when the debt starts to decline, even if this scenario actually happens, you're talking about debt to GDP ratio of more than 85% of GDP. And let me remind everyone that in the FRBM we had said what is an appropriate debt to GDP ratio. You're using a number of methodologies was close to 60% of GDP. Let me shift gears a bit and move to monetary policy and the central bank. And clearly, I think the market perception seems to be that the central bank is the main game in town. And RBI has reduced policy interest rates by 115 basis points since the crisis hit, and also combined policy rate changes with other tools like liquidity injection, long-term repo operations, and regulatory measures. And in fact, if you look even in a cross-country perspective, it remains India's conventional policy rate easing actually looks comparable with the average support we have seen across emerging and advanced economies, though still lower than, say, LATAM and CEMEA. I think the challenge has been, this is well known. I think Dr. Subbarao has worked on it, and this is well known. This is a usual problem. I think transmission has been a usual problem given the structure of the financial system. I think so despite the repo rate cut of 115 basis points, lending rates have declined by like 40 basis points. And this is the usual problem that banks are essentially not willing to cut rates as deposits and household savings are at historical lows. And even while policy rates are down, the rates paid by government on small savings are still significantly higher. And and transmission has continued to be weak despite several nudges by the RBI moving from base rate to marginal cost of lending rate, and then to introduction of external benchmarks on the asset side more recently. I think that said, domestic financial conditions have eased. This is, a financial condition index. This is a simple average of weighted average actually of short-term interest rates, long-term interest rates, equity prices, and spreads. They have come down significantly, and that should be supportive of growth going forward. If you look at spreads for non-bank financial companies in particular, they have declined too, but still remains at fairly elevated levels, compared to pre-crisis. I think despite the easing of financial conditions, I think my sense overall so far is of a less aggressive policy stimulus compared to the previous episode. So this basically, the left-hand side chart shows a high frequency current activity indicators and the change in the current activity indicators across different episodes. And the right-hand chart actually shows the policy response. So a positive means monetary policy cut, interest rate cut, fiscal policy easing, and actually we don't have a real effective exchange rate. Negative actually means the other way around, so it's an appreciation or a drag on growth. So as you can see, clearly from this figure that this is the deepest. Even if you look at high frequency indicators, not the GDP, this is the deepest crisis. Even if you look at data up to now. And if you look on the right-hand side, the policy support has been less aggressive, even compared to the global financial crisis, and of course compared to some of the other slowdowns which India has had. And if you look at real effective exchange rate during this episode, the real effective exchange rate has actually appreciated, and that would clearly be a drag on growth. I think what is striking about this is that, and Dr. Subbarao mentioned in his opening remark, even when the shock was different in nature and less severe in the global financial crisis, the policy support was in fact bigger. And this time around, I think initial conditions are in fact weaker in India. You went into this crisis with a negative output gap, a weak financial sector, yet the direct support from macroeconomic policies so far has been strikingly smaller in magnitude. Let me shift gears a little bit and talk about the restart and the associated challenges. So this chart actually shows Google mobility data and how it has evolved, across different states in India since the crisis hit. And just to let you know that, from early May, when the first wave of relaxation started, mobility began to improve. But interestingly, now for a number of states, it's actually going the other way around, and it's plateauing for states as well. And there's a lot of variation across states. If you look at Tamil Nadu, for example, it has reported, the highest increase in mobility, and you did see virus cases accelerating and reimposition of lockdowns. I think Maharashtra, has been more, has seen a more, flatter slope. I think the important point to note is that, even though mobility has picked up since the relaxation started, it still remained fairly below normal. So if you look at Delhi, for example, it's still 60% below normal. And that will, of course, have an impact on economic activity. I think the main question which arises in our minds is the increasing mobility, is it causing the virus to spread? And basically, in order to explore that, I'll just ignore the regression results and just focus on this. Basically, we define states according to the degree of reopening, states which reopen more and states which reopen less. And the red bar is you see how the growth rate of active cases, and the reds are basically states which reopen more. And clearly, I think in the month following the relaxation of restrictions, states which reopen more did have a higher growth rate in active cases. Again, I'm not showing here, but even if you adjust for testing, I think this pattern comes out. With this, let me give a quick summary of what I said. I think, look, the context is that Indian economy was weak in 2018-19, but really was appearing to be near a trough, at least cyclically. And just as things were starting to look up at the beginning of this year, the rising tide basically gave way to the virus shock. And what I tried to do in the last 30 minutes or so is just present a very quick overview of the macroeconomic and fiscal implications, and lay out some of the challenges. Look, globally, again, Dr. Subbarao talked about it. It's the most unprecedented shock in post-war history, and some people are comparing it with the global financial crisis, but shock is truly different this time around. As I said, deepest recession, at least since the Second World War for the world as a whole. Things were looking good, but actually now, there are key risks to the global sequential recovery as well, given that the virus has not been brought under control in the US and in several emerging economies. And as I showed you that chart, India really looks as an outlier relative to the rest of the region. I'm going to skip the rest of it and probably just move to the last chart, the last slide. And just to say, we always focused on day-to-day short-run management issues, but I think this is really the IPF is probably the forum to think through, where will growth come from in India in the medium term, and what will be the key macroeconomic drivers of growth. As I showed you, discretionary fiscal policy support defined as targeted support to households and businesses. The kind of policy support that can revive any economy quickly in times of an unprecedented shock has been very tepid in our view. Monetary policy has been the game in town. However, transmission of conventional monetary policy continues to pose challenges. And exchange rate has actually remained remarkably stable in this crisis, and RBI's real effective exchange rate has actually strengthened by 4% since pre-COVID. So that would also be a drag on growth. So you can think about that, look, pent-up demand, favorable base effects, and massive policy support in advanced economies driving global recovery could lift India's economy in 2021 and beyond. But we really, I think the bottom line is that we really struggle to see any domestic fundamental forces to drive growth in the medium term. And I'll just conclude with, what we see the key risks to India's medium-term outlook. I think the key risk, I think not a surprise to everyone, is the pandemic not being brought under control over the next few months. The second risk, I haven't talked about it much, is clearly domestic financial sector risks. I think post-COVID, the government has announced a series of credit guarantee schemes, several regulatory measures, moratoriums. All these pose a host of implementation challenges. This is true not only in India, but across the world. I think the key risk, which I see, is a lack of significant credit offtake from these programs, and at the same time building a host of medium-term risks in the system with regulatory forbearance leading to moral hazard, higher NPLs, or risks relating to fraudulent practices. And finally, I think the third risk to watch, I talked about it, is the fiscal risks. I think nominal GDP is going to be in a contractionary mode. That's going to put a sharp upward pressure on government's fiscal and debt position. And interest growth differential turning positive, debt dynamics is likely to turn adverse. I think the interesting thing is that the market participants and credit rating agencies are actually less worried about the worsening of fiscal and debt positions in the short term. In fact, it's actually the reverse. They appear to be more concerned about the fact that, look, India may not have the administrative and fiscal capacity to implement a large support program, and that would be a big headwind to growth. So I'll just conclude by saying that I think what would reassure markets and probably avoid further credit rating downgrades for India is not lower fiscal spending in the short run, as many perceive, but more importantly, a proper strategy to revive growth and combined with a credible fiscal plan for the medium term. I'll stop there. Thank you very much for giving me the opportunity.
Dr. Subbarao, you're muted. Dr. Subbarao, you're muted. There you go.
Okay now? Thanks.
Very good, very good.
Thank you, Prachi, for a very comprehensive paper, cogent analysis, perceptive insights, and very clear forecast. It's a very grim scenario, but all your trademark strong qualities. Now let me turn to the discussants. First to Dr. Shankar Acharya, where Shankar can give any silver lining to this very grim scenario. Over to you, Dr. Acharya, 10 minutes.
Shankar, unmute yourself, please. Shankar, yeah, there you go.
Thank you, Subha, very much. Very nice to see you after quite a few months, even though virtually. That's true for my other panelists also, Vijay, Prachi, I greeted already. And I see a few other familiar faces on the screen here. Yeah. Now, can you hear me?
Yeah. Yes, yes, we can.
Okay, good. Now, a topic like Whither the Indian economy tempts one to talk for at least an hour. But of course, Shankar had said, no, you'll have 15 minutes. And now, of course, Subha has squeezed that down to 10 minutes. So I'll make my points in a somewhat more staccato way than perhaps I might have otherwise done. I won't try to cover all the territory that Prachi could, because in 30 minutes, you can do a lot more. Let me just focus on a few points on growth projections and beyond in FY21 and beyond, and related issues. Let me also say, Subha, that I think Prachi's been remarkably optimistic. I won't be quite so optimistic. First, let me say a word about the evolution of growth projections during the year, FY21. As you may recall, around February this year at budget time, most participants hoped or expected growth to be around 5 to 6% in the FY21. After the lockdown began and sometime in April, institutional projectors, if you like World Bank, IMF, various investment banks, credit rating agencies, and so on, certainly through April and I would say at least the first half of May, was still looking at GDP contraction of some GDP positive of about 0 to 2%. I found that quite incredible because by mid-May, I think one had seen some awful high frequency numbers, and certainly knowing in something from the inside about what the lockdown looks like, I could see no reason to be in positive territory at all. So round about May, I think I put forward a couple of scenarios. I'm mentioning those because they're pertinent in terms of comparing Prachi's with mine and others too. And these scenarios, this was I think on May 14, exactly 2 months ago, basically did a quarter by quarter kind of picturing of what might be happening to growth during FY21. And you had for the full year in one scenario, GDP going down by about 11%, that was the optimistic one, and in the other by about 14%, the less optimistic one, if you like. By the way, I was not the only one doing this. Pranab Sen had similar kind of expectations, and as far as I know, I think he would still stand by those, about 11, 12 minus for the full financial year. The NCAER in its first version of its quarterly review had a number of scenarios, and one of them was about 12%, and the others were much more optimistic based on various kinds of interventions. Now, in the subsequent 3 weeks after May 14, I think we saw a lot of revisions by the institutional projectors, as I loosely call them, IMF, World Bank, investment banks, including Goldman, and others, credit rating agencies and so forth, so that they came around, broadly speaking, to the -4 to -7% range. I think as Prachi and Goldman came down to -4.4, and but others, I think like State Bank was around -7 and so forth. I won't go into the details of those, but broadly the range was rounded up between -5 and -7% for the full year. To my mind, actually what is more interesting is that a subset of these projectors, all of us, if you like, were and I think about half a dozen of these projections actually gave numbers projecting for what was going to happen in Q1 of FY21. That includes Prachi and Goldman, of course. And I think she's in fact at almost the kind of the most pessimistic, I think, -45%, if I remember correctly. CRISIL was -25%. NCAER in its revised paper was -26%. Mine, if you were respectively two scenarios, I hadn't changed them, -25 and -33% for the Q1. And Pranab Sen, as far as I can recall from his paper, was -37%. So note that Prachi's is actually the worst in comparing quarter to quarter, year on year, whereas her full year projection was much more in the sort of standard moderate range, as I call it. Not in the double digits as some of us are. Prachi, I'll make the following bet with you, that if Q1, and I'm using fiscal year here, goes down by 45%, as you expect, there's no chance of getting anything below. I mean, let's put it this way. It's very, very likely that the full year will be above -10% for the full year. And I'd be most surprised if it's at the range that you say. So let's have a look at these numbers a year or so hence and compare notes. Basically, my view is that if we got knocked down by the lockdown to the extent of about -25 to -30% year on year for Q1, then scrabbling our way up to quarter by quarter. I agree what's going on is now sequential improvement. That's no question about that. But we're still in negative territory if you look at it from a level point of view, and will be throughout the year. And scrabbling our way up, I see really from -25 and range of -25, -30, we're almost certain to end up in double-digit minus for the full year. Now, here is where I think we also should really be focusing when we talk about growth during this year and also the next, not just at the growth rates, but very much at the level of what's happening to quarterly GDP as you kind of draw the picture quarter by quarter. Because I agree that we are probably going to see some version of a modified V, and we are already seeing that, a very sharp down in Q1, something of a improvement going on in Q2, which has just begun, of course, so we don't have any data for it, and so forth. But in level terms, it will be, I think, a miserable story throughout the year. We'll be well below the average quarterly level for 2019-20 in real terms for GDP throughout the year this year. And my view would be, and this is really in many ways the key question, what will be the point in time when we recover to, say, the average quarterly level of 2019-20? I don't see that happening till the second half of 21-22. And that's assuming that the unlockdown, if you like, proceeds relatively smoothly, of which the current evidence is not that very good. We are getting a lot of, if you like, rollbacks for medical reasons, maybe sound medical reasons, I don't know. In Maharashtra, Pune, Tamil Nadu, Chennai, and Bangalore, and so forth. So I think it's going to be significantly grimmer than the picture that Prachi painted. As I say, my expectation is, if we are lucky, we'll get to the 2019-20 GDP levels in the second half of 21-22. What about sort of beyond 21-22? And this will depend, I think, pretty obviously on what's happening to the global economic environment, what's happening to the pandemic, and our own policies this year and next. And I'm now talking about after 21-22, 22-23 onwards. On present trends on all these counts, and all this will change, so we'll have to revisit as time goes on. I really don't see a growth in the medium term in India being outside the range of 3 to 5% annually for several years after 21-22, for a variety of reasons. Now, so let me before I move on also make one point which arose more from the discussion presentation than my initial reading of the paper, that I have to say, Prachi, I disagree with you strongly on your characterization of the fiscal situation. Without getting into what discretionary means here, that'll take a lot of time. I think if you use the standard definitions of fiscal deficit and fiscal impulse, 21-22 will see pretty substantial fiscal deficit. Combined deficit would be, in my view, 12% plus, essentially because of huge revenue shortfalls. And impulse, if one is comparing to the previous year, you will see, plus 5% or so. Now, the point why that's not going to matter a whole lot from a GDP point of view, if you like, the production point of view, is what's, I think, the determining factor is the supply side during this year. Of course, supply and demand go together, I understand that. But if you like, most of the time, the binding constraint is going to be coming from supply. Essentially, what proportion of economic activity is allowed to happen because of either lockdown or unlockdown, or social distancing and so forth, that will carry on and live with us for a good long time. Now, when we come to the policies and your, if you like, key concerns, I think we are in much closer agreement. I think the key thing here, looking forward, is going to be that we must manage localized lockdowns better than we are doing, because otherwise we are hitting supply, and supply is the name of the game for this year and next year. You're hitting supply more than you should by public policy. It's not going to be easy, and I don't have any silver bullets here, obviously, because this requires enormous medical knowledge as well, which I don't have. Secondly, I agree with you that the issues of debt sustainability will emerge, especially as I regard, the fiscal kind of situation this year is going to be pretty loose in terms of the standard measures. And, you'll have government debt up to 85% of GDP in nominal terms. And given what's happening to nominal GDP growth and interest rates, you will have sustainability of debt issues, which we'll have to grapple with. We also will have to have major challenges in grappling with, if you like, the rebounding stress on our financial sector. It's been under stress for quite a few years, as a lot of us know. Things look to be improving until COVID hit. And now, of course, because of the COVID lockdown and so forth, there's enormous stress on the financial sector, and it's going to be a huge challenge for whoever's making policy to grapple with that. I think a couple of things that you did not mention, Prachi, which I would emphasize on the policy side as we look to the future. One, I think we need to, I don't think personally we'll succeed, but we need to try to keep a strong commitment to open trade policies. It's not happening. It hasn't been happening for the last 3 years in terms of policy here, but it's something that we must try to do, because otherwise, of course, we gain less from the updraft in the global economy. That's going to be coming. We have to remember that. But I see all sorts of problems there, particularly, of course, now that it's complicated by all the unpleasant events on the northern frontier of our country. We must also, I think, seriously try to live by the slogan of ease of business, because one of the consequences, if you like, heritage, legacy, if you like, of COVID and its reaction from policy, the lockdowns and continued mini lockdowns, has been that the conferment of massive discretionary authority to different layers of government, which is often implemented in uncoordinated, sometimes unjustified, and very challenging, of course. I'm not saying any of this is easy, but the result is we are, I think, getting, as far as economic agents are concerned, particularly producers, but to some extent consumers, into a situation which is quite reminiscent of the worst days of the license permit Raj. So we must fight to not kind of make that a permanent state of affairs. I think I've taken up my time, Subba. Thank you very much.
Thank you very much, Shankar, for that very thorough analysis of the extent of contraction and for clearly indicating where you agree with Prachi and, importantly, where you disagree with her. I'm disappointed, though, that you painted a very grim picture. We were looking to you for giving some silver linings, but I know that you gave your best professional estimates. And thank you very much also for those policy pointers towards the end. They're very useful. Thanks very much, and good seeing you once again. Now let me turn to Professor Vijay Joshi, Oxford. Professor Joshi.
Right, can you hear me?
Yes, of course, yes.
Okay. This is a very interesting and very nice paper. I won't go on singing its praises because I have only 10 minutes. But what I will say is that it could become even more of a valuable paper and help policymaking if it discussed policy options a little more in greater detail than it has. A couple of minor points about the early parts of the paper. I wish that there had been more detail about the employment and unemployment situation, because that is important both from a welfare point of view and macroeconomically. And I also think that there could have been a little more detail about the destruction of supply chains. And we always say this is partly a supply shock and partly a demand shock. Can that be given any empirical content? Now, I come to the main points that I want to talk about. The paper makes the important point that government discretionary fiscal support has been only 1.8% of GDP, and the fiscal impulse is only around 0. Now, these are very important points. The concepts of discretionary fiscal support and fiscal impulse are not very commonly understood by non-macroeconomists. And I think a little time could be spent explaining them and also showing why the government's figure of 10% of GDP as the fiscal stimulus is highly exaggerated. And if the fiscal impulse figure is to be believed, then that means that there is hardly any fiscal expansion at all. That's a very important point, and I think you know, the author should really try and explain that in some depth. Now I now I come to the main gap in the paper, which is a discussion of policy options as of now. Hints, the paper says that there hasn't been, that I think it uses the word tepid to describe the policy response. And I think I certainly agree with that. And I think for the purposes of this discussion, I shall put up an Aunt Sally that the author could, and all of you, could either embrace or knock down. And doubtless the fiscal hawks among you will ask themselves whether what substance I've smoked before I'm giving this talk, but these comments, but I shall take that risk anyway. So as I see it, the task before the government is twofold. The first one is what I call a recovery objective, which is to get the economy back to normal working. And the second is what I might call the inclusive growth objective, which is to correct the drift which has been happening in the last few years and return the economy to rapid and inclusive growth, but with a credible medium-term fiscal consolidation plan. As the author correctly observes, capital markets are not much concerned about overruns and fiscal deficits and debt, rather the reverse. But what they are looking for is a strategy to revive growth, which of course also contains a credible plan for medium-run fiscal consolidation. So, coming to the recovery objective, it is, I think, given the extent of the extent of the slump, it is extremely important to support incomes and consumption across the board. It is so on humanitarian grounds, but happily there is no conflict, I think, with macro policy at this point, because with the easing of the lockdown, a multiplier expansion of demand is necessary. Indeed, it is essential to incentivize the rebuilding of supply chains and the return of workers and jobs to cities. And the conventional monetary policy has its limits because of transmission problems. So the main action has to be in fiscal policy. And my Aunt Sally that you may want to knock down is that there should be an immediate immediate and additional universal cash transfer of at least 1% of GDP, possibly 2% of GDP. And I say universal in order to avoid any problems of identification, because that would lead us into problems we don't want at this point. Now, how would this stimulus be financed? Well, in my view, it should be financed, that half of it should be financed in the normal way, and half of it should be financed by printing money. You can call it helicopter money if you wish. You can call it selling bonds to the RBI if you wish, but it's basically printing money. This would, which would amount, even if the fiscal expansion was 1%, was monetized if the fiscal expansion was 1% of GDP and it was monetized to the extent of 0.5% of GDP, that would increase the money supply. There would be a one-off increase in money supply of around 2 or 3% of GDP. Now, the objections to this kind of move, the usual objections, are that this would be inflationary. But note that, first, oil prices and commodity prices are low, food stocks are high, current inflation is running at 6% because of the destruction of supply chains, but there is a lot of disinflation coming along the way. And it is in fact important at this point to revive demand if supply chains are going to be revived. Import demand will increase under this scenario, but that's not a worry because we are starting from a current account surplus and the reserves position is very comfortable. The second objection is, so I don't think inflation it should be worried about at this point. The second objection is that printing money could become a habit, but I don't find that plausible given that we now have a credible inflation targeting regime. The third objection is that markets will take fright, but I don't think that's correct. The markets are looking for a revival plan, so long as it also includes a medium-run consolidation plan. Now I turn to the inclusive growth objective. So if the economy is returning to normal, then we also want to have a step up in growth, and this objective can be pursued either sequentially or simultaneously with the recovery objective. The elements of the unfinished reform agenda are well known. I don't have to go into them. A lot of people, including myself, have written about it. Some modification may be needed because of the virus, because of the pandemic, but not the essentials. But any reform program will require more financing, more public investment, more social expenditures on health and education, and possibly on cash transfers, and more fiscal consolidation. And how can that be achieved from a macro financing point of view? Note that there's a huge amount of potential fiscal space that would be available once the economy has returned to normal, if we have a program for winding up dysfunctional subsidies, for winding up dysfunctional tax exemptions, for more extensive privatization, for taxation of agricultural incomes, and for winding up inefficient social welfare schemes. All these things put together could yield 10% of GDP. There is no shortage of fiscal space if we can do these things. In addition, I would say that it would probably be quite safe to conduct some extra borrowing externally from either official sources or from commercial sources. So this requires a medium-term strategy in addition to a recovery plan. But if the government took the opportunity of this crisis to call on to have a complete reset and embark on this ambitious path, that I think would be better than playing it.
Vijay, you've muted yourself for some reason. Vijay, we couldn't hear the last couple of minutes.
So where shall I start from?
Just the last minute or two.
Well, I was just. Did you get the business about the potential fiscal space?
Yes.
Yes. Well, I was saying there is potential fiscal space, domestic fiscal space, if certain things were done, which I outlined. And there is also the possibility of some extra borrowing from external, official, or commercial sources, which I think would be reasonably safe because India is not unduly exposed on that front. So there are two paths that the economy could take, government could take at this point. One is to play very safe, but that I think is likely actually to hinder recovery and to continue the drift. And the second one is the more ambitious one, is to take some risks, but to use the occasion for some immediate expansion and for a complete reset of the economy. And that my vote is for the ambitious path. Thank you.
Thank you, Professor Joshi, for that very clear critique of Prachi's paper, as well as for laying out your own roadmap for policy options going forward. I particularly like the fact that you actually put some numbers on this. Thank you very much indeed. So we have a few questions coming from the participants. Let me get the ball rolling. Prachi, are you around?
Yes, Dr. Subbarao.
Oh, okay. The first question is about fiscal policy. You said, and Professor Joshi reinforced your point of view that the market is not going to be agitated by fiscal expansion. You actually said that the market is actually concerned about the government's fiscal rectitude. And Dr. Joshi said that the government can borrow and spend as long as there is a clear policy for management of the fiscal and for economic recovery going forward in the short term and in the medium term. But here's the question. In your debt to GDP analysis, you show that even after we hit the peak and start declining, the debt to GDP ratio comes to about 85% of GDP. That's way, way above what the FRBM committee said is the optimal limit for debt to GDP. And in fact, all the rating agencies in their recent evaluations pointed out the debt to GDP as the main concern for medium-term growth prospects. So how do we square this? On the one side, we have a mounting debt to GDP ratio. On the other side, you're saying borrow more as long as you have a clear plan. How can you show a clear plan when your debt to GDP ratio is going to go to 85% and remain there for the foreseeable future?
Dr. Subbarao, this is a great question. Let me say that, no matter what, whether we spend beyond this, whether India spends beyond this 1.8% of GDP discretionary fiscal stimulus or it does not, we are talking about a fiscal deficit of, as I said, for the sovereign of 15% of GDP. And this is with just a minimum discretionary stimulus. And I think the issue is that, during these times, India does not have fiscal space to spend more because we did not save in good times. So we are in a situation, sort of a catch-20 situation where, what kind of policy, this is an unprecedented shock. What kind of policy support can actually work is discretionary fiscal policy support. There's been a huge first round impact of the pandemic. The role of policy is to minimize the second round effect. If I work in a restaurant, my restaurant has been shut down, I lose my job, but I have a marginal propensity to consume. And I have a 60% say marginal propensity to consume. So that has second round effects. Policy can only minimize the second round effects of the pandemic. And that's what policy support can do. India does not have fiscal space to do the kind of policy support which many advanced economies or even other emerging economies have done. And that's what markets are worried about. That look, it's the fact that India does not have fiscal and administrative space to implement the kind of stimulus, implement the kind of stimulus which is needed to revive the economy is what is worrying markets. Rather than the fact that, fiscal deficit rising from, say, 12 to 13% of GDP to 14% of GDP in the short to medium run. I think that's broadly what I meant, but I think the broader picture is that I think what generally I think market participants are looking for is a framework. How is the government thinking? What is the loss of output from this pandemic? Like, our view is that the loss is at least 10% of GDP, which actually Dr. Acharya thinks is fairly optimistic. If you go from 5% to 6% of GDP to minus 5%, you're already 10 percentage point gone. And how are you going? That's almost 20 lakh crore rupees. How are you going to compensate that? What is, what parts of the policy are going to actually fill the puzzle? And this is, and then, once you decide the split between different kinds of policy, then, then you think through, how much additional borrowing you need and how do you finance this additional borrowing, which is going into some of the issues which Professor Joshi raised. So I think big picture, I think what markets are looking for is a framework and a strategy from the government, which I think they have not got. I'll stop there.
Dr. Subbarao, we have several people who've raised their hands. I don't know if you see them. I see Rajeshwari Sen Gupta, Raghuram Rajan, Ajay Shah, then Govinda Rao has his physical hand up, which is great, and then Sudipto Mandal and Karthik Muralidharan. So perhaps we can make sure that we get to these people.
Actually, I can't see the people who've raised their hands.
I'll tell you, it's Rajeshwari Sengupta first. And if I can just request everybody to be brief because we want to make sure we get as many people in. So,
okay, Rajeshwari, please go ahead.
Thank you so much. Prachi, it was wonderful listening to your presentation and great to see you again, albeit virtually. So I have a question which is also related to what Professor Joshi said, which is that knowing that now India has very limited fiscal space to engage in any further fiscal stimulus, no matter how exceptional the circumstances are. But given the unusual situation, how feasible do you think is it for the RBI to engage in something like deficit financing within the framework of inflation targeting? Because there's a lot of talk going on about that we can be complacent about inflation given the situation, and the RBI should print money if push comes to shove, which it has in order to finance the deficit. So what would be your take on that? And the other point very briefly I had is, you said financial conditions are easing, but isn't it also the case that the risk aversion in the banking system is at an all-time high? The bank credit growth has been very low, and that would be another additional drag on the economy with the moratorium that's in place and no clarity about what happens once that moratorium is lifted. Thank you so much.
Dr. Subbarao, may I also suggest that we take a few questions together and then have... so it's Raghu next. Raghu?
Thanks. That was a very good discussion and presentation. Look, Prachi, I mean, you focus a lot on growth, but I think implicit in what you're saying is also potential growth is deeply, deeply damaged. So the prospects of returning to anywhere, and this is the point that Shankar also made about levels. I mean, what we don't seem to be taking into account is this pandemic is different from the normal recession in that it's damaging the players in the economy seriously. Households are going to be deeply scarred with very low reserves. It's hard to imagine that many of them will start consuming after the initial bout of pent-up consumption, and we shouldn't mistake pent-up consumption for longer-term consumption. Our MSMEs are in deep trouble. They started already in a bad way with the series of shocks they've been subject to before the pandemic. With the pandemic, a significant portion will not survive. That's true in the United States with all the supports. Think of India where there are no supports. How many will start up after that? That's a serious loss to the economic muscle. The financial sector is going to see a huge rise in NPAs after this. The only measure we have for dealing with this is the NCLAT, which we've suspended for new cases. How are we going to deal with the huge mounting loans, bad loans in the financial sector? And I've even heard my business friends in large firms talking about the problems they have in starting up again, even debt-free firms. Now, in this environment, focusing on your credit rating is just nuts. Your credit rating doesn't depend just on your level of debt. It depends on how you're going to grow out of the debt. And if we have a seriously damaged economy, we cannot grow out of that debt. So I think the vicious downward spiral that you talk about is really on, and we can't worry about spending. We certainly have to focus the spending, but we have to repair the damage now. Now, the last point I want to make is I read the FM's piece. I don't know when it was written, but it is thoroughly disappointing in what it talks about. It first blames the previous crowd. That's taken for granted in a politician. But then it talks about the Janthan, Janthan, Vijay just talked about the difficulty we have in targeting transfers to people. We're still talking about universal because we can't target, given that Janthan doesn't really work as advertised. On bank reforms, she talks about how wonderful Gyan Sangam, etc. has been. The level of NPS is going to be unprecedented 6 months from now, if we really recognize the true level of NPS. We just suspended the IBC, which is one of the signal reforms of this government. The one positive is agriculture, which is doing well. And certainly the government has come up with reforms, but these are reforms which have been talked about for a long time. Will they be implemented? They certainly can be beneficial for some significant portion of our economy, but we are in trouble. And the sooner we recognize it, the better it is, because we really need to deal with this problem.
Dr. Subbarao, we have one more. I think maybe then we'll request Prachi to come in. Ajay Shah's next. Ajay?
Hi, Prachi. Thanks. That was very nice talk.
Ajay, we have difficulty hearing you. Ajay, I'm sorry, we can't really hear you. Your bandwidth is really very low. Would you mind writing in your question, please?
Yeah.
Thank you. Thank you so much. Just write in your question on the chat. Thank you.
Yeah.
Thank you. And let's then just take one more question with Sudipto Mandal.
Thank you. I just have a couple of quick comments. First of all, on the epidemiology that Prachi started with, like her, I'm not an epidemiologist, but I think that looking just at the numbers on cases, which are a function of not only the actual number of cases, but also the amount of testing and so on, can be somewhat misleading, and a much more robust variable to look at is actually the number of deaths, in particular the increase in deaths from one day to the next. And in fact, on that, we noticed that while the way the lockdown was rolled out and the unnecessary humanitarian crisis that it created, on the side of the spread, it actually has been very effective, because from about 20% increase, daily increase in deaths, that rate has now come down to less than 3%. It's about 2.5% today, and that's quite a dramatic change. So that, along with the distribution of the spread to a few states, are the two factors we need to keep in mind in, in other words, very grim picture. Coming to the economic question, just a quick point on that. Shankar referred to the issue of, Prachi saying that there's only a 1.8% fiscal stimulus, but then comes out with a fairly optimistic estimate of only 4.4%, minus 4.4% growth. This Prachi paradox, if I may call it that, actually underlying that is, I think, is a misunderstanding of the actual extent of the fiscal stimulus. You have to take not just the Atmanirbhar Bharat program, where it was indeed about 1.5% of 1.8%. But in addition to that, the fiscal deficit already there in the central budget, in the state budget, the extra borrowing, not to mention the off-budget borrowing and so on. And as Prachi herself, I think at some point mentioned, the PSBR is actually close to around 15%. And even if you take that compared to last year, that is a very large fiscal stimulus or fiscal impulse. I personally think the fiscal stimulus has to be computed not just from last year, but from where we were after the decline in revenue loss and so on. So the baseline from which you compare is what would have happened, the counterfacts of what would have happened if the government had not done all this extra borrowing and so on. In any case, the main point is that removes the kind of paradox that we see. But even taking a minus 4.4%, partly because of the huge destruction of supply capabilities and supply chain with Raghu and Shankar referred to, I think more stimulus on the demand side is going to translate into more inflation rather than revival of growth. We're already seeing that the minus 6% inflation that we're already seeing. But that being said, I think we can do more in terms of on the demand side, not in order to generate more macro demand, but really for the humanitarian aspects and for reasons that have been discussed by Vijay and others. We should just forget about all this unnecessarily complicated way of trying to do targeting and just make it available as universal income support in addition to the food support that has been given. And there are estimates that have been done that this would not add up to some huge frightening cost, 1% in my reckoning, about 2% of GDP if you give each family about 1,000 rupees a month. So there's a lot to be done on that side, but this creates a bit of tension. This is my last point, that if your potential growth has been shrunk and you're not going to grow at more than 2-3%, if that, On the other hand, your fiscal consolidation and containment of the GDP ratio going forward is going to require, great fiscal prudence. That is a big policy challenge. And to deal with that, I think apart from this reorienting expenditure I just referred to towards humanitarian spending, the openness of trade policy is very important to take, as Shankar mentioned, to take advantage of the global economy when it revives. But on both these counts, unfortunately, there seems to be a blind spot in the government.
Dr. Subbarao, maybe we should ask Prachi to...
I think so. And I think she's in a more difficult position than the finance minister. Prachi, go ahead.
Sure. Thank you. Thank you, first of all, to Professor Joshi and Dr. Acharya for the discussion. And thank you for all the excellent comments to Raghu, Shudipto, Rajeshwari. I'll take just a few minutes and, just divide my intervention into short-term issues. I think a lot of people raise that. Long-term issues in the lines of what Raghu said. And then, I think more financing, RBI monetizing kind of issues. I think on the short-term issues, I think maybe I didn't clarify well enough, and that relates to Dr. Acharya's points as well, is, I'm basically talking about Q-on-Q annualized rates of minus 45%, and that increasing to 20% Q-on-Q annualized GDP gain in Q3. And that translates, if you translate them into, if you accumulate this Q-on-Q growth rates and translate them into year-on-year rates, that basically implies for the first quarter of -9, and I gave a little bit of rationale as well, and that slowly improving to -5, -2, and -1. I completely agree. While you said repeatedly that you disagree with me, I actually quite agree with you. And I do think that, the risks to the Q3 number, especially the 20% Q-on-Q annualized gain in Q3, or a -5% year-on-year, risks are to the downside, and because how the economy is evolving, and this whole reimposition of lockdowns, which we are seeing, Bihar just announced complete lockdown in the state, an hour ago. So clearly, I think risks to the Q2, the fiscal year Q2, that is the quarter we are in, are to the downside. And just to clarify that, and that would mean my guess is additional. I mean, we are in the totally contractionary territory, and I think the numbers can be huge depending on how the economy evolves. I think secondly on the long-term, medium to long-term issue, I think Raghu has raised really deep points and very valid points. I think we've not officially downgraded our potential growth forecast. We still think trend growth at 6%, but really I think as there's uncertainty on all these fronts. I think number one, how the virus situation evolves. Number two, how policies to evolve, policies, to deal with the virus situation evolving in the country. Different states are, following, different, the risk aversion is different across different states between lives and livelihoods, etc. How consumers and businesses adapt. The point that Raghu raised, which I think is very, very important. I think people like you and me, and we are not going to feel, at least I'm not going to feel comfortable going to malls and restaurants for a while. So how businesses adapt. Some of these migrant laborers have come back who had left, but I think a lot of them have not come back. They're actually feeling better off back in their rural areas. Manrega employment is picking up. Monsoon has been good. Kharif sowing has been good. So a lot of these, especially the services industry, has to do huge. Has to adapt to a huge degree, and finally, how economic policies evolve. I think the approach of policymakers has been more reactive rather than proactive. So I think we have to see how that evolves as well. So I think as the uncertainty, if we get more certainty along all these fronts, I think we'll get more clarity on how potential growth is shaping up as well. But clearly, I think risks to the 6% trend growth are to the downside. I think finally on, financing issue, this also, and, RBI coming and, monetizing, etc. It also relates to Dr. Subbarao's question in the beginning. I think, this is not a first order question for me. I think the first order question for me is, how much has the economy been impacted? and what is the overall magnitude of the policy response that is needed. And out of that policy response, how much is, how much is discretionary fiscal policy? And then comes the question of, how much is discretionary fiscal policy? How much is automatic stabilizers? And once that is decided, then, you decide how can it be funded? How much can non-market forms of borrowing absorb, whether it's loans from external sources or, other non-market forms of borrowing? What is the residual, market borrowing? Then again, and then, how much are banks, mutual funds, insurance companies going to absorb? And of course, central bank is there and would fill the gap. And whether it does in the primary market or the secondary market is actually, a second order issue, the kind of first order issues we are dealing with at this point. Just one last point, on the credit rating agency point, which Raghu raised, that, look, credit rating agencies, it's just silly to focus on credit ratings right now. Credit rating agencies themselves are saying this, that we actually don't want you to worry about, fiscal and debt rising, today. This is happening across the world. What you need is, strategy to put growth up on track and, show us a medium-term plan for the fiscal. So they themselves are crying and saying that look, don't worry about it. And here, I think, on the other hand, I think the arguments we're hearing from the policymakers is, look, we can't do fiscal because we are worried about credit rating agencies, which is, a bit paradoxical. So I'll stop there, Dr. Subbarao.
Thank you.
Dr. Subbarao, we still have a few more people, and I think we have a bunch of questions in the Q&A box as well. Should we I can see Karthik Mullidhar, and I know that Govinda Rao had his hand up as well. If we can just request them to be short, if you recommend that, then we can.
You're the organizer and the time manager,
so we are 5 minutes over, but we probably started 5 minutes later than we should have. So I think with everybody's permission, we can. This is really a fabulous discussion. Prachi's paper is great, and the comments are coming in are great. So I think we should continue for another 5 to 7 minutes more.
So Karthik Muralidharan now.
Yes, can you hear me? Yeah, I'll make this very quick. So I think the first is just to comment to Vijay Joshi. I think this is why tomorrow when we have the session on social protection, we specifically requested the expenditure secretary to join us. And so we'll hopefully get a little bit of the government's view with regard to ability to spend. I think, so Prachi, one again, comment and a quick reaction. See, I think it's clear that the government's approach to stimulus for the most part has been through the credit channel so that, it's not actually money that they're spending. So, but I mean, as we know that there isn't enough demand right now. So the one place where the credit channel may in fact be much more effective, but which has not been used as much, is with actually the state budgets, right? So because the states do have shovel-ready expenditure, and the states are kind of in as much fiscal stress, if not bigger. And here it feels that this really miserly relaxation of the borrowing limits at like 0.25%, and that too conditionality. And I think Govinda Rao has written about this, that the conditionality itself is deeply troubling from a constitutional perspective. But even leaving the conditionality aside, it feels like the case for either ways and means advances or other ways of bolstering state capacity to borrow should be an almost no-brainer, because the states are still on the hook to pay back, and the government wants to stimulate through the credit channel. So is that, yeah, I mean, my sense is, yeah, that should be done, and wanted to get your quick reactions to that, because I am worried that towards the end of the year, you're going to start seeing states in kind of such a fiscal crunch that, shovel-ready projects will not happen, and that's going to be even more contractionary.
Govinda Rao.
Thank you, Subbarao, for giving me the opportunity. Prachi, it's an excellent paper. Enjoyed reading the paper. And of course, excellent comments by Shankar and Vijay. I'm only actually supplementing what Raghu said on the impact on the potential growth. Karthik did mention about the state's role in the entire scheme of things. In the overall government spending, much of the capital expenditure comes from the states. On an average, about 3% of GDP capital expenditure comes from the states. Now, the decline in their own tax share and their own taxes and the share from the center will be much more than 2% of GDP additional borrowing space that has been told with conditionality, as I said. Possibly, with the type of projections in GDP that we are making, the states are likely to really have a huge problem And the capital, forget about the capital expenditure. Even their revenue expenditure at the level that exists may not be, they may not be able to do. I'm doing some help for both Punjab and Tamil Nadu at the request of Montek and Rangarajan respectively. And I see a very huge problem happening there. And so this will have a potential impact on the growth. So I think that's something which you need to take into account, because the capital expenditure of the center is just about 1.5, 1.6% of GDP. 3% of the GDP actually is being spent by the state because their revenue deficit is hardly, sort of marginally, they are in the revenue deficit. All the entire borrowing actually they have been using for the capital expenditure. So you have a huge problem there.
Thank you. Prachi, you have any final comments on this? Very erudite comments.
Dr. Subbarao, we have almost a large number of almost more than 150 attendees. So could we take one question that Prachi may choose from the Q&A that we've received in the Q&A box? I realize we are stretching time and our next panel is ready. I see Rajesh Bhushan has already joined. But Prachi, would you like to pick up one of the questions in our Q&A box? Or I can read one for you if you like.
Prachi, you're on mute. Yeah.
Shankar, sorry, please, I have some connectivity issue. Please go ahead. I cannot see the questions.
Let me see. So I guess there's Gunajit Kalita asking about potential growth and really, I guess, supplementing the points that Raghu and others have made, saying how will this COVID recession mean for India's long-term potential growth? How will this episode impact factor production of growth in terms of capital, labor, and productivity? So it's a similar sort of question. And there's another question very quickly from Professor Shankar at IEG. Some of the economists like Sudipto Mandal, N.R. Bhanumurthy, and others are arguing that the stimulus is actually higher than 10% of GDP, while you say, Prachi, that it is much lower. Any explanation for such a large difference? This actually relates to work that Sudipto and Bhanu put forward in the NCER's quarterly review of the Indian economy. So I'll stop there. Prachi.
Sure. Quickly on Karthik's question and also related to Dr. Govindarau's question on state budgets, our sense is that this 5% enhanced limit, I think bulk of the additional funds is going to go on revenue expenditures rather than capital spending, given the weak implementation capacity, and also the project pipeline is fairly is fairly small. So in principle, yes, I think that could be a plus for growth. But I think in practice, go on each state government's website, check what the project pipeline is. There's not a lot. And implementation capacity, I think states are dealing with a lot more challenges now than actually focusing on infrastructure or capital expenditures. I think potential growth, I already answered that question. I think Raghu made some excellent points. I think clearly risks are that potential growth is going to be downgraded by several institutions. But I think right now there's a lot of uncertainty. As I said, uncertainty on four fronts: how the virus is going to evolve, how policies to control the virus are evolving, especially at the state level, how consumers and businesses adapt, and how policies adapt as well. Finally, on the stimulus question, I think this is a methodology which we use across the world. So all the announcements by the government, we go through each and every announcement and see which one is actually targeted support to households and businesses. The kind that can revive the economy very quickly in times of an unprecedented shock like this. And that I'm happy to share the details. It comes out to be much smaller, about 1.8% of GDP. Basically, is the Manrega spending and some of the other support to households, mostly households. For businesses, I think there's not been much direct support. I think so it's more like directly handing money or food in the hands of the people. I mean, things or infrastructure spending, but infrastructure spending is actually not that much. So I'm happy to share the details on how we come to 1.8% of GDP. I'll stop there.
Thank you, Prachi, and I think we should conclude the session now. Shankar, is that correct?
Yes, Subba.
Okay. So I think between Prachi, who presented the paper, Shankar and Vijay Joshi, discussants, and all the people who asked questions, we presented a very grim scenario, but that's the realistic scenario. So just to finish this on a slightly less grim scenario, I just want to raise one point or make one point that did not come up in the discussion, which is that we are actually seeing in the economy today a two-speed recovery, or actually a two-speed contraction. The rural economy is doing slightly better than the urban economy, which is still grappling with the COVID-19. Rural economy accounts for 65% of the population, 45% of the GDP, is actually proven to be a buffer because of the expanded Manrega spending, the spending power that's come because of the payments under PMGKY, enhanced procurement by FCI, which has put money in the hands of farmers, and it enabled the government to extend the Universal Food Security Program to the end of November. And of course, a favorable monsoon, which augurs very well for the agriculture sector. Somewhere I saw that together this accounts for about 1.7% of the GDP, and that's a happy sign. So I just want to end the session by noting that in all this very grim scenario, there are some silver linings, and we must recognize them and see how we can leverage on them as we engineer a total recovery of the economy. With that, I want to thank Prachi for an excellent paper and very, very cogent replies to all the questions. To Shankar and Vijay Joshi for their very studied and measured and very erudite discussion, and to all the people who asked the very searching questions. And thank you, Shankar, for giving me this opportunity. Thank you.
Thank you, Subba, for steering this session. I realize we are running 15 minutes late, but let's move right into the next session.